Hello, my dear students. Now we can have a quick revision into the entire topics of your paper number 13, Corporate and Economic Laws. So as I usually mention, since this is a fast track revision, we'll be touching each and every chapter and we'll be discussing the core points of each and every chapter. Okay, so first we'll move to the chapter Declaration and Payment of Dividend. So basically there are two types of dividend. Number one is interim dividend. Number two is final dividend. Interim dividend is a dividend which is declared by board of directors. Simply you can say that between two AGM, or it is a dividend which is declared by board of directors during a financial year or during the period from the end of the financial year till AGM. Okay, there is no approval of members, but after declaring that will be approved by members. In the case of final dividend, the board will be recommending a rate and the members will be declaring or approving that. That is final dividend. So when you are discussing about the sources, when we are discussing about the sources of your interim dividend and final dividend, with respect to interim dividend, there are three sources. Number one is surplus in P&L account, profit of the financial year, profit of the quarter. And we have learned that if the company has incurred loss up to the quarter preceding the date of declaration of interim dividend, the rate of dividend shall not exceed the average rate of dividend declared during the immediately preceding 3 financial years with respect to your interim dividend. With respect to your final dividend, there are two sources. Number one is profit after providing depreciation as per Schedule 2 of current financial year, preceding financial year or years remaining undistributed or out of both, or the amount which is given by government to the company. Okay. Then when we are discussing about the flow chart of the dividend, the entire chapter of dividend, that is we have section 123 to 127 is being discussed in this chapter. So with respect to the process flow of declaration of dividend, the board will be recommending the rate of dividend which will be approved by members. Within 5 days of declaration, it has to be transferred to a separate scheduled bank account. Within 30 days, the dividend has to be paid. If dividend is not paid within 30 days, and if there is no legal or legitimate reason for that, they in the sense the company and the directors who are knowingly a party to the default will be liable for punishment. Okay, the punishment or the penal provision can be avoided under section 127. The penal provisions are explained in section 127. So the section 127 punishment can be avoided if the dividend non-payment of dividend is due to operation of any law, if any direction or instruction has been given and that instruction direction was given by shareholder, such instruction or direction could not be complied and the same is communicated to the shareholder. Okay. Number 3, if there is any dispute or if the amount of dividend is legally adjusted against amount receivable from shareholder or if it is due to any other reason. So simply speaking, if dividend is declared, it has to be paid to the shareholder within 30 days of declaration. If you are not paying within 30 days of declaration, company will have to, they will be liable for interest at the rate of 18%, 18%, and directors will be liable for directors who are knowingly a party to default will be liable for imprisonment up to 2 years and 1000 per day penalty will be there. Okay, so if you are not paying the dividend in 30 days, it may be because of any valid reason, or if it may not be having any valid reason, you have to transfer the amount of dividend to unpaid dividend account in the next 7 days, which is explained in section 124. If the amount of dividend remains in unpaid dividend account for 7 years with a company, means it is a scheduled bank account, it will have to be transferred to IEPF. IEPF provisions are explained under section 125. Okay, so with respect to the final dividend, if there is no profit or if the profit is inadequate during a financial year, the company can pay dividend, final dividend. Please note the company can declare final dividend out of free reserves only with respect to final dividend. So if you are declaring your final dividend out of free reserves, you will have to comply the provisions of rule number 3 of company's declaration and payment of dividend rules 2014. Okay, so the amount which you are withdrawing from the free reserves should be lower of the following four amounts. Number one, average rate of dividend declared during immediately preceding 3 financial years. Number 2, 10% of paid up plus free reserves. Number 3, the amount which is calculated under step number 2 minus losses if any. Number 4, amount drawn from reserves shall not fall below, or the amount of free reserves shall not fall below 15% of paid up. So these are the four provisions with respect to your rule number 3. Okay, that's about your declaration and payment of dividend. Then we'll move to the chapter insurance. Okay, so Insurance Act, you are having principles of insurance. So utmost good faith is there, insurable interest is there, proximate cause is there, indemnity is there, subrogation, then contribution is there, loss minimization is there. Utmost good faith means both the parties. There will be three parties in an insurance contract, most probably. Number one is the insurer or the company. In between that, intermediary will be there, insurance intermediary or insurance agents will be there. Number three, insured. So basically, there are two parties. Number one is insurer, the company, and the insured. So both the parties to give clear and concise information regarding the terms and conditions of the contract, which is known as utmost good faith. Okay, insurable interest means the insured, the party to gain if the asset is existing, the party should have gain. Okay, and to incur loss when it is destroyed, lost, stolen, etc. Okay, that means that the person, the insured, should be the real owner. Okay, then number 3 is proximate cause. Proximate cause means the nearest cause will be taken if it is not insured against all the causes. Okay, then indemnity, the insured will be restored to the previous position before losses. That clearly specifies the insured will not be entitled to make any profit out of the insurance contract. Okay, then subrogation means after indemnifying, all the parts, pieces, scraps will be owned by the insurer or the insurance company. Then contribution, what is the actual loss which is incurred by the insured, that will be indemnified by the company. Suppose the insured has taken policies from two companies, X amount is the loss. Suppose 10 crore is the loss, both the companies will be giving indemnifying up to this amount, up to this 10 crore. It doesn't mean that both the companies will be giving 10 crore each, which will be giving profit to the insured. Okay, so that specifies, that contribution specifies that what is the actual amount of loss that you have incurred, that amount will be reimbursed, sorry, that amount will be indemnified by the insurer. Loss minimization means all the steps have to be taken by insured to minimize or to reduce the losses. Then with respect to minimum paid up requirement, which is specified under section 6, life or general insurance, minimum paid up is rupees 100. For health insurance, for companies which are doing health insurance exclusively, it is 100 crore. And for reinsurance exclusively doing insurance unit, it is 200 crore. Please note that if you are counting, if you are calculating this amount, you will have to exclude preliminary expenses. Preliminary expenses will have to be reduced or should not be considered while you are calculating this amount. Okay, then with respect to the loans which is provided by insurance companies specified under section 29, insurance company cannot provide loan to certain persons which is specified under section 29 subsection 1. They cannot provide loan to its directors, its managers, its actuary, auditors, manager, then any firm, entity, or any other entity in which such persons means director, manager, holds such position. But the insurance company can provide loan to any person on certain ground. That is, if the person is policy holder of that insurance company, life insurance company's policy holder can be given loan by the life insurance company on the surrender value of its policy. The amount of loan which is given should not be above the surrender value. It should be within the surrender value, and it should be given on the security of life insurance policy. Then number 2, it can give loan to banking company. It can give loan to holding company, subsidiary company with the approval of board of directors. Okay. So 29 subsection 2 specifies that on life insurance policy, loan can be given by insurance company. Then to banking company it is allowed. Then to holding company, subsidiary company after satisfying certain requirements. With respect to the provision of nomination, nomination is specified under section 39, which is applicable only to life insurance policies. Nomination is applicable. Minor can also become nominee. In the case of you, if you are appointing minor as nominee, you will have to appoint another person who is known as appointee, and that person will be getting all the benefits if the person expires when the nominee is minor. Okay. Then with respect to assumption of risk after receipt of premium, which is explained in section 64 VB. Okay, only after receipt of premium you can assume the risk. Okay, you cannot assume the risk without receiving premium or without receiving the premium in advance, or even if the premium is not guaranteed. Okay, with respect to questioning of life insurance policy, which is explained under section 45 of Insurance Act 1938. After 3 years, you are getting, or you are taking the date from 3 particular areas. Number 1, date of issue of policy, date of commencement of risk, date of revival of policy, date of rider, whichever is later. Okay, so which date is later? From this date, within 3 years, you can question the policy. After 3 years from this particular date, you cannot question the policy, life insurance policy. So within 3 years, if you are questioning the policy, there are 2 grounds. Number 1 is misrepresentation of fact or suppression of fact. Number 2, on the basis of fraud. If it is misrepresentation or suppression of fact, the policy can be repudiated, and the paid premium will be paid in 90 days. Okay. If it is in the case of fraud, the policy will be repudiated, and there is no need to pay the amount of premium which is paid by the insured to the insurance company or to the insurer. Okay, so in the case of fraud, there is no need to repay the premium, but in the case of misrepresentation of or suppression of fact, the amount of premium which is paid by the insured will have to be paid by the insurance company within 3 months or 90 days. Okay, so we'll now move to the concept of Banking Regulation Act 1949. So in Banking Regulation Act, we know that section 7 is there. It is mandatory for every banking company to use either bank, banker, or banking company. Okay, no other body, no other association shall not use these terms unless they are not carrying banking business. Okay, it can be used by any mutual, means any association of banks can use these terms if they are formed for protecting the mutual right and interest of banks. Okay, with respect to section 9, which is specifying the disposal of banking non-banking assets. So if any immovable property, non-banking assets are acquired by the bank, it has to be disposed within a period of 7 years. Okay, RBI can give extension of maximum 5 years if it is satisfied it is in the best interest of the banking company and the depositors. Okay, but if the bank is acquiring such assets for own use, there is no need to be disposed. Okay, then with respect to section 17, there is the provision of reserve fund. Reserve fund minimum 20% has to be maintained by every banking company, but RBI circular has requested every banks to keep 25% to the reserve fund. If you want to keep less than 20%, you have to keep on central government approval. The process is, the bank will have to apply to Reserve Bank of India. Reserve Bank of India will recommend to RBI, and central government, Reserve Bank of India will will apply to central government. I'm sorry. Central government will be approving only if the amount in reserve fund plus share premium account is not less than the paid up capital. Okay. Then with respect to cash reserve ratio of non-scheduled bank, please note that many students are having doubt in this topic. They will be searching the Google and saying that so many students used to ask the question, CRR is this much and all. It is specified to non-scheduled bank, that is 3% is specified to non-scheduled bank. Scheduled banks will have to follow the monetary policy which will be issued by RBI on time to time basis. Then we are having statutory liquidity ratio of 25% and maintenance of assets. Okay, as a person, 75% of time and demand liabilities has to be maintained as assets by the banking company. Now we will move to appointment and qualification of directors, which is a topic under Companies Act. So with respect to number of directors, this chapter comprises of section 149 to 172. With respect to minimum and maximum number of directors specified in section 149 subsection 1 clause A, and clause B is specifying with maximum number of directors. So in the case of OPC, minimum 1 director, maximum 15, private minimum 2, maximum 15, public minimum 3, maximum 15. The limit of 15 can be exceeded by passing special resolution. The maximum limit means the limit of 15 and the special resolution for appointment of directors beyond 15 is not required for government company and section 8 company, which clearly means that these two companies are not having the provision of maximum number of directors. They can appoint directors as 18, 19. There is no need for any approval. Special resolution is not required by these companies. Okay, then we'll move to the type of directors, the provision which is related to type of directors. You can classify the directors into three categories. Number one, directors who are specified in articles of association, directors who are appointed by members, directors who are appointed by board of directors. With respect to the directors who are specified in articles, it is only the first directors. Okay, if first directors are not specified in articles of association, you will have to check whether regulation 60 is applicable or whether regulation 60 is not applicable. Normally in articles of association, your first directors will be specified. Okay, if regulation 60 is applicable for your company, the first directors will be determined by majority of subscribers. If regulation 60 is not applicable to your company, all the individual subscribers will be automatically becoming the first directors. Okay, so when you are discussing about the directors who are appointed by members, you are having Indian resident director 149 subsection 3, woman director 149 subsection 1 proviso 2, small shareholders director section 151, independent director section 149 subsection 4. So Indian resident director means which is applicable to every company. Every company should have at least one director who has stayed for 182 days or more in the financial year. Okay, in the case of woman director, which is applicable to two classes of companies. Number one is listed company. Number two, prescribed classes of companies, which are unlisted public company having paid up 100 CR or above, or turnover 300 CR or above. Okay, any vacancies in the case of woman director or independent director will be filled by board of directors at the earliest, but not later than 3 months from the date of vacating the office or the date of next board meeting, whichever is later. In the case of small shareholders director, which is applicable only for listed company can appoint small shareholders director either suo motu or on application given by small shareholders, which will be 10% of the total small shareholders or 1000 small shareholders, whichever is less. They will be making an application to the company, the board of directors, and they will be appointing small shareholders director accordingly. They will be making application to board of directors in the sense that they will be making application to the company. It will be appointed by members only, not board. And then independent directors applicable to classes of companies like listed company. Number two, company, unlisted public company having paid up 10 crore or above, turnover 100 crore or above, loan debenture deposits in excess of 50 crore, which is not applicable. Unlisted companies, certain unlisted public companies are not required to appoint independent director Number 1 is wholly owned subsidiary, dormant company, joint venture. Then the directors who are appointed by board of directors who are specified in section 161, subsection 1, subsection 2, subsection 3 and subsection 4. Additional directors will be appointed by board of directors and they'll hold the office till next AGM. Person who fails to get appointed in general meeting cannot be appointed as additional director. Okay, if a director leaves India for 3 months or above, the board of directors will be appointing another director in the place of that director, original director. If a person leaves India for 3 months or above, the person who is leaving is known as original director. In place of that original director, another director will be appointed by board of director. Don't think that if director leaves India for 6 months, that director is not appointing. Just like in the case of proxy, the director is not appointing. The appointment will be made by board of directors and such director is known as alternate director. Don't use alternative director. So many students use that. It is alternate director. Alternate director's tenure comes to an end when the original director returns to India or when the tenure of original director expires. Then nominee directors are the directors who are nominated by third parties, Reserve Bank of India, banks, Securities and Exchange Board of India, and they will be appointed by board of directors. They are nominated. RBI will be nominating this person. We want to appoint this person on your board, and the decision to appoint that will be taken by the board of directors. Then filling of casual vacancy, which we have already discussed in the case of woman director, in the case of independent director, if there is any vacancies, please note, if there is any vacancy in the case of directors who are appointed by members, that can be filled by board. 161 subsection 4 clearly specifies board of directors can fill casual vacancy only of that directors who are appointed by board. So if one director is appointed by board and there is a casual vacancy, suppose there is a resignation of that director, that vacancy can be filled by board. Board cannot fill the vacancy of the post of a director which was originally appointed by board of directors. Okay, yes. Then we will move to the concept of rotational and non-rotational directors in the case of public companies only. Okay, the rotational and non-rotational directors is applicable for public companies only. Okay, 152 subsection 6 and 152 subsection 7. So public company, in public company, minimum 2/3 of the directors to be rotational. So what is rotational? That directors will not be having any particular tenure. Non-rotational means they will be having specific tenure. Just like additional director, it is a specific tenure till AGM. Alternate director, till that director returns to India, that is a tenure. So directors without specific tenure is known as rotational. Minimum 2/3 to be rotational. Minimum 2/3 of the total directors. Total directors, which excludes independent director, directors who are appointed by any statutory bodies formed under special act of a financial institution formed under special act of parliament. Okay, then maximum 1/3 can be non-rotational directors. So suppose if 9 directors are there, 2/3 minimum means 6 directors to be rotational. So out of this 6, 1/3 means 2 directors will be rotating each and every AGM. So who will be rotating? The director who has been longest in the office will be retiring. Okay, so means 6 directors are rotational, out of which 1/3 will be retiring at every AGM. So 1/3 we will be taking the 1/3, and when who will be retiring means the director who has been longest in the office will be retiring. If everyone was appointed on the same day, it will be by mutual agreement or by taking loads. Okay, then we will move to the concept of disqualification of directors, which is explained under section 164. There are 3 kinds of disqualification. Number 1, subsection 1, subsection 2 and subsection 3. Subsection 1 is personal disqualification. Then subsection 2 is on the basis of default by company, additional disqualification only for private companies. Okay, so personal disqualification like unsound mind, undischarged, insolvent, etc. On the basis of default by company means there are certain defaults. If the company fails to file annual return or financial statement for 3 consecutive financial years, or fail to pay interest on deposit, repay deposit, interest on debentures, redemption of debentures, or fail to pay declared dividend, and the failure continues for 1 year or above. Okay, and that in such case 164(2) the director will be disqualified to be reappointed in the same company or appointed in any other company for a period of 5 years. Okay, then we have the vacation of office. 167 subsection 1 specifies the vacation of office, under which scenario the director has to vacate the office, like when he incurs disqualification under 164, when he absents himself from all the board meetings, when he contravenes the provisions of section 184, fail to disclose interest in any compromise arrangement, etc., are specified in 167. Then resignation of directors. Directors can resign by intimating the company in writing. Then removal of directors. Directors can be removed by passing ordinary resolution. So before ordinary resolution under section 115, 115, a special notice has to be filed with the company. Special notice means a notice which is given by the company, by the members having 1% of voting power or holding 5 lakh rupees, whichever is less. It has to be given at least 14 days before general meeting and not earlier than 3 months of general meeting. So once the special notice is received, that will be discussed in the general meeting, and the director can be removed by passing ordinary resolution. But if the director is appointed by special resolution, just like the independent director second term, independent director will be having one term of consecutive 5 years. In the second term they will be appointed by special resolution. So if the director is appointed by special resolution, the removal will also require special resolution. Okay, then right of persons other than retiring directors to stand for directorship. So if a person want to stand as a director for or he want to participate in the election, 1 lakh or such higher amount has to be deposited with the company, and if he gets elected or if he secures more than 25% of the votes, he will be refunded with that amount, otherwise the amount will be forfeited by the company. Then 162, section 162 specifies appointment of 2 or more directors in single resolution, which is not possible, but which can be made possible by getting the approval of members with no votes being casted against and passing of ordinary resolution. So every directors, if you want to appoint directors in general meeting, this is not the case of board meeting. In general meeting, if you want to appoint directors, they have to be appointed by different separate resolution. But if you want to appoint 2 or 3 or 4 directors in a single resolution, you will have to get the approval of members with respect to the kind of voting and with no votes being casted against. Then once the approval is obtained, you can give the ballot to the shareholder, to the members, and if ordinary resolution is passed, you can appoint such directors. So the number, which is 8-digit number, which is required to become a director or designated partner of an LLP, is known as DIN or DPIN, designated partner identification number. A person cannot apply, obtain or possess more than one DIN. It cannot be cancelled, surrendered, deactivated except in certain circumstances, like wrongful means, if it is obtained in wrongful means, fraudulent manner, then death of DIN holder, if the DIN holder become unsound mind, insolvent, okay, etc. Then we'll move to chapter 12 of Companies Act, which is explaining about the meeting of board and its powers. Chapter 12 of Companies Act dealing with meetings of board and its powers. So with respect to with respect to board meeting, number of board meeting, we can classify the discussion into two. In the case of one person company, small company, dormant company, startup private limited company, minimum one board meeting in each of calendar year half and gap not less than 90 days. With respect to other companies, minimum 4 board meetings and gap not in excess of 120 days. Not in excess of 120 days. Okay. Then with respect to mode of attending board meeting, section 173 subsection 2 specifies a director can attend either through physically present video conferencing or other audio visual means. But if the person is attending through video conferencing or other audio visual means, he will have to comply, the company will have to comply rule number 3 of meetings of board and its powers rules. Okay, yes. Manner, condition and other legal requirements for attending board meeting through VC or OAVM. Then with respect to quorum, section 174 is explaining the provisions of quorum. So in the case of section 8 company, the quorum is 25% of total strength or 8 directors, whichever is less. In the case of other company, 1/3 of total strength or 2 directors, whichever is higher. So this provision will be rounded off to next digit. The rounding off will be to next digit. Then with respect to passing of board resolution, there are two methods for passing board resolution. One is through circulation. Number two is certain items will have to be discussed only at board meeting, which is explained in 179 subsection 3. See, we will be using circulation if an item could not be discussed at board meeting and which cannot be deferred till next board meeting, and if the item is of routine nature, and if the cost of conducting board meeting is very high, you can go for circulation. Circulation means you will be giving all the draft resolution necessary papers to all the directors. Okay, and if you are getting the majority, that will be passed. There is no need for quorum and all. Okay, but if 1/3 of the directors, 1/3 of the directors who are entitled to vote demands that it has to be discussed at board meeting, that has to be discussed at board meeting, which cannot be passed through circulation. Then we have certain committees of your board. One is 177 audit committee, which is applicable to the companies which are specified in our independent directors threshold. Listed means you are having these two thresholds similar. Audit committee and NRC is applicable for listed company. Unlisted public company having paid up 10 crore or above, turnover 100 crore or turnover 100 crore or above, outstanding loan debenture deposit in excess of 50 crore. In the case of Vigil Mechanism Committee, which is also under 177 subsection 7, specifies that it is applicable for listed company, company which has accepted deposit from public, company having borrowing from bank and PFI in excess of 50 crore. So it is to safeguard the employees and directors. Victimization, safeguarding the employees and directors. So Stakeholders Relationship Committee 178 subsection 5, a company in which there are more than 1000 shareholders plus debenture holders plus deposit holders at any time during a financial year, they are required to constitute a stakeholder relationship committee. Okay, with respect to the contribution of board, you are having contribution to charitable fund, contribution to political party, which is explained in 181, political party 182, national defense fund is 183. Charitable fund contribution limit is like this. The average, you have to calculate the average net profit of preceding 3 financial years of your company. If the contribution is up to 5% of the average, 5% of average of 3 financial years you have calculated. If the contribution is up to 5% of average net profit of preceding 3 financial years, board resolution. Then if it is exceeding 5% of average, up to 5% of average net profit, you are having board resolution. Then above 5% of average net profit, you will be requiring ordinary resolution. 182 political party contribution. Political party contribution can be made by any company except government company, a company that has been in existence for less than 3 years. Okay, all other companies can make political contribution, but it has to be in account pay check, account pay draft, any other instrument or ECS method. There is no limit for making political party contribution. Then board of directors can approve to the contribution to national defense fund or any fund which is being used for the benefit of national defense. We are having related party transaction. We know the discussion related to related party. Related party is explained in section 276 like directors or relatives, KMP relatives. then a firm in which director, manager or relative is partner, etc. With respect to related party transaction, you have to understand what is related party. Okay, what are the transactions which are coming? There is no provision in Companies Act which is specifying that related parties should not transact with the company. Related parties can transact with the company, but only with approval. There are two kinds of approval. One is board approval. Number two is ordinary resolution. If your transaction is related to goods, sale, supply of material or goods, if your transaction is related to supplies, sale of goods, the threshold is 10% of turnover. If it is related to property, it is 10% of net worth is your threshold, 10% of net worth. Then leasing 10% of turnover, services 10% of turnover, office or place of profit more than 2,50,000 in a month, then excess of 1% of net worth in the case of underwriting. So if you are meeting this threshold, you will have to get the approval of members by way of ordinary resolution. Otherwise, you will be requiring board resolution. Means if the transaction is related to sale, purchase or supply of goods, the threshold is 10% of turnover. Suppose the turnover is 5,000 CR and the 10% of turnover is 500 CR, means turnover of last financial year. So 500 CR is the limit. So if the amount of transaction in this financial year is reaching 500 crore, means 10% of turnover or above, you will be requiring ordinary resolution. Otherwise, you will only be requiring board resolution. Okay, in certain case of transactions of arm's length and all, you can give omnibus approval. Audit committee can give omnibus approval. So now with respect to chapter 13 of Companies Act, which is relating to appointment and remuneration of managerial personnel, you are having the discussion related to MD 2 clause 54, 2 clause 53 manager, 2 clause 94 which is whole time director. Okay, so MD means who is having substantial powers of management either by articles, either by agreement, by board resolution or resolution by general meeting, which is made by members. Manager means who is having the powers of whole of the management of the company, who is subject to the superintendent's direction, control of board, which means that person will be under the board. Okay, but the thing is that if you are appointing one person as manager, another person cannot become manager or MD. So normally in Indian scenario, we will not be appointing manager, we will be appointing MDs so that we can appoint multiple MDs. So 196 subsection 1 specifies that no simultaneous appointment of MD and manager. The term for MD, manager, whole-time director is 5 years, one term of 5 years. Then their disqualification is specified in section 196 subsection 3. Approval of these persons, like board of directors approval will be there, then members approval should be there, and in certain cases central government approval is also required for appointing these professionals. Suppose you are appointing one person as MD, okay, but in the next general meeting that will have to be approved by members, but members did not approve that, the validity of the act which is done by that managing director or the professional will not become invalid. That is validity of act specified under 196 subsection 5. So with respect to remuneration given to these directors when there is profit, okay, which is explained in section 197, overall remuneration is 11% to all the directors, MD, whole-time director, manager, 11% of net profit. If you want to exceed this limit, you can exceed by passing ordinary resolution. Okay. Suppose if there is only one MD or whole-time director in your company or one manager in your company, only to that one person, suppose MD, manager, whole-time director is a category. If there is only one person from that category, you can give 5% to that person. If there are more than one person from that category, collectively you can give 10%. Okay. To other directors who are not MD or whole-time director, if there is no MD or whole-time director in your company, you can give 3% to each of your directors. If there is MD or whole-time director in your company, you can pay 1%, only 1% to each of your directors. But if you want to increase these limits, you can pass special resolution and increase that limit. Okay. Then we will move to the concept of SEBI provisions. So in SEBI, you are having 3 chapters. So first we'll move to raising of finance in your material, or simply SEBI ICDR regulation 2018. So you are having the provision with respect to persons who are not eligible to make IPO or FPO. There are issuer, promoter, selling shareholder, director who are debarred by SEBI, or any promoter or director who are promoter director of another company which is debarred by SEBI. Okay. Then willful defaulter or fraudulent borrower, fugitive economic offender, or if there are convertible securities. So with respect to the eligibility routes for IPO or FPO, you are having profitability route and QIB route. So profitability route, you are having 4 conditions. You have to comply these 4 conditions. Once you are complying these 4 conditions, you can go for profitability route. Number 1, net tangible assets of 3 crore or above in 3 financial years of 12 months each. Okay. Then average net operating profit of 15 crore or above. Then net worth of 1 crore, minimum 1 crore should be there. Number 4, if the company has changed its name during the preceding 12 months, minimum 50% of the revenue to come from the activity which is associated with the new name. Okay. Then if you are doing IPO, the conditions are you have to make agreement with the stock exchange, with the depositories. Then all the existing shares should be dematerialized. Okay. Then partly paid up shares to be fully paid up, etc. These are the general conditions. Additional conditions like minimum 1000 allottees should be there. Minimum subscription of 90% should be obtained. If it is not obtained, you have to make the refund within 4 days. Then if issue size exceeds 100 CR, credit rating agencies to be appointed as monitoring agencies, etc. These are the additional conditions for making your IPO, FPO. With respect to prohibition of insider trading regulation, insider means a person who is connected person or the person who is having access to UPSI. And SEBI prohibition of insider trading regulation specifically specifies that you cannot communicate unpublished price sensitive information. But it is for, if it is for legitimate purpose, if it is to your banker, if it is to your supplier, if it is to lender, it is known as legitimate purpose or discharge of legal obligation or performance of duties. You can do the same, but the person to whom you are sharing will be treated as insider, and you will have to comply, you will have to ensure that data is not violated or data is not being published or misused by that person. Okay. Then structural digital database has to be made by the company, and the details of such person should be maintained by the company for 8 financial years. Means if you are giving to the banker, the employee of the company who is giving to that banker, the identifier of that banker to whom that is given, then the nature of data which is being given, etc., to be stored in structural digital database. Okay. Then there are 2 disclosures. Basically, initial disclosure is there, continuous disclosure is there with respect to uh, your insider regulations. Means when you are joining a company, you will have to make disclosure. Then afterwards, if a trading by the insider in a calendar quarter exceeds 10 lakh, you will have to make a continuous disclosure to the board or respective persons. Then SEBI substantial acquisition of shares and takeover regulation 2011. You are having acquirer, person acting in concert, target company, and open offer disclosure. See, this is very simple. The chapter specifies that SEBI takeover code is applicable only when the target company is listed. Okay. When the target company is listed, your SEBI takeover code will be applicable. If the target company is not listed, you will have to comply with the provisions of section 235 236 of Companies Act 2013. Okay. So suppose if a company acquirer plus PAC holds less than 25% in the target company, and acquisition is entitling them to exercise 25% or more voting rights in the target company, you will have to make open offer of 26% extra. That means you are having less than 25% in target company, and this acquisition is entitling you to exercise 25% or more voting rights in the target company. You will have to give additional open offer of 26%. Suppose if you are having 25% or more existing shares in the target company, more than 5% in a financial year, more than 5% in a financial year will entitle you to make open offer of 26%. Okay, that is the core part of takeover code. Now we will move to Foreign Exchange Management Act, or simply FEMA. So you will have to, or we have to discuss the provisions with respect to the residential status in the case of FEMA. You have a person is there, PRI is there, person resident in India, person resident outside India. So residential status is determined by if the person is residing for more than 182 days in India in the preceding financial years, that person will be termed as PRI. But that person will not include person who is leaving out for employment, business or vocation, or any other purpose in which circumstance would indicate stay for an indefinite period. Okay, then an entity which is registered in India will be treated as PRI. Branch, office, agency in India will be treated as PRI. Branch, office, agency outside India will also be treated as PRI upon satisfaction of certain condition. Like you are having 4 conditions for determining the residential status. Number 1, with respect to the individual residential status, which is more than 182. Don't think that it is 182 or more, just like in the case of taxation, it is more than 182. Number 2 is entity registered in India. Okay, if an entity is registered in India, automatically it will be treated as PRI. Number 3 is that if branch, office, agency outside India, okay, or if a branch, agency, or office is in India which is owned or controlled by PRI, it will be treated as person resident in India. In other case, branch, office, agency outside India owned or controlled by PRI will also be treated as uh, person resident in India. Okay, so there are two situations: either branch, office, agency in India owned or controlled by PROI. Otherwise, branch, office, agency outside India owned or controlled by PRI. Okay, then if the person is not PRI, that will be treated as person resident outside India. Then you are having two kind of transactions in FEMA. Number 1 is current account transaction. Number 2 is capital account transaction. Current account transaction means the transaction which are not capital account transaction. Capital account transaction means which alters assets or liabilities, including contingent liabilities, in India of PROI or outside India of PRI. I am PRI. If a transaction is altering assets or liabilities outside India, my assets or liabilities outside India, that is capital account. If I am PROI, if any transaction is altering assets or liabilities in India, it will be treated as capital account transaction. So, with respect to your current account transaction, you are having prohibited transaction, government approval transaction, then certain transaction in which RBI approval, liberalized remittance scheme will be there. So under prohibited, you have this is to current account, not to capital. Current account transaction, just like your lottery, then traveling to Nepal, transaction with person resident in Nepal, etc. These are under prohibited category. Then central government approval means if you are like sponsorship of sports outside India, then vessel charges chartered by PSU, etc. are central government approval. Cultural tours, okay, etc. RBI approval for individuals and non-individuals is there. For individual, under liberalized remittance scheme, for drawing more than 250,000 USD in a financial year. So that means up to 250,000 USD in a financial year, you are not requiring any approval from RBI. With respect to personal visit to any country, gift, going abroad for employment, immigration, medical studies, etc. Okay, with respect to non-individuals, there are certain criteria with respect to LR. Okay, liberalized remittance scheme. If it is donation, there is a particular criteria. If you want to make payment to persons abroad for sale of flat or residential plots, there is a separate criteria, etc. Okay, then you are having a foreign direct investment, FDI. With respect to your FEMA provision, FDI is investment through capital instruments by person resident outside India in an unlisted Indian company, or investment in 10% or more of post-issued paid up capital of a listed company on a fully diluted basis. Means all after or converting all, it is known as diluted basis. ECB, external commercial borrowing, commercial loans which are raised by eligible resident entities from recognized non-resident entities. It should conform to parameters like minimum maturity, permitted and non-permitted end users, maximum all-in cost ceiling, etc. Then we'll move to the Competition Act. Competition Act, we are having Section 3, Anti-Competitive Agreement, Dominance, Abuse of Dominance, Section 4. Then Combination, Section 5 and 6. Anti-Competitive Agreement, horizontal is there, vertical is there. Under horizontal, price fixing is there, limiting production or supply is there. Then allocation of market share, bid rigging. Vertical, tie-in arrangement, exclusive dealing, not supply, exclusive dealing. Exclusive distribution agreement, refusal to deal, resale price maintenance. Please note that under horizontal agreement, you can say that it is void. Under section 3, it is specified that if you are entering into horizontal agreement, because if the persons who are entering into agreement are in the same marketing stage, it is void. But if it is in the vertical scenario, that will have to be decided by Competition Commission of India on case to case basis. We cannot say, if that question is being asked for the examination, don't write that it is void. Please write it will be decided by CCI on case to case basis. Abuse of dominance, section 4. Dominance means it is a position of strength which is enjoyed by an enterprise which enable it to operate independently of competitors, or it can control its customers or competitors in its way. So dominance is not bad, abuse is bad under section 4. So now we will move to section 5 and 6 combination. So we have undergone an amendment. An amendment was applicable from June 2025 examination with respect to combination threshold. So if an merger, amalgamation, acquisition is satisfying any of this condition, it will be treated as combination. So assets, the threshold is more than 2,500 crore, or turnover more than 7,500 crore if the parties are individuals and they are having assets and turnover only in India. And if it is group, more than 10,000 crore or more than 30,000 crore. If any enterprise are having assets or turnover outside India, if in the case of individual, it will be more than 1.25 billion and minimum 1,250 crore in India, or more than 3.75 billion and minimum 3,750 crore, I'm sorry, in India. Then in the case of group, it will be more than 5 billion and minimum 1,250 crore in India, or more than 15 billion and minimum 3,750 crore in India. Please note, this provision has undergone amendment from the last examination itself, June 2025 examination itself. Now we will move to the provision of money laundering, PMLA. Money laundering means earning of income deriving property by committing a scheduled offense and projecting it as untainted property or money. If you are earning of income or deriving a property by committing an offense, by committing scheduled offense means which is specified in Part A, Part B or Part C of schedule. Part A 29 paragraph, Part B 132 of Customs Act, Part C offenses of cross-border implications. Then scheduled or predicate offense, which I was mentioning, Part A 29 paragraph, Part B 132 of Customs Act, Part C, that is of cross-border implications. In the stages of money laundering, there are three stages are there: placement, layering and integration. Introduction of funds in the financial system is placing. Then moving fund to the distance, continuous conversion, playing coming back of the funds to the country by way of investment in real estate, business assets, luxury assets, etc. It is known as integration. So you are having a reporting entity and its obligation. Reporting entity will be bank, financial institution, intermediaries, etc. Then suspicious transaction report, which if the reporting entity is having a thought that the transaction is involving proceeds of crime, unusual circumstance, not in the bona fide purpose, they will be reporting the same. Okay. Chapter 14 of Companies Act with respect to inspection, inquiry and investigation. Please note that inspection and inquiry will be the power of ROC. ROC will be making under section 206 power to call for information, inspect books, inspection, ROC power. Then after that they will be involving in investigation. Means after making the inquiry, after making the inspection under section 208, ROC will be giving a report to the central government which specifies whether investigation is required. If investigation is initiated, it may be by 210 central government, 213 Serious Fraud Investigation Office, NCLT, SFIO 212, NCLT 213, investigation into membership 216, related companies 219. Then we'll move to chapter 15 of Companies Act, which relates to compromises, arrangements and amalgamation. Okay. So compromise means basically means one party is foregoing another thing, one party is adjusting another thing. Okay. So for compromise, arrangement, amalgamation, which is explained in chapters 15, section 230 to 240, you will be requiring the approval of NCLT. So you will have to apply to NCLT. So once you have given the notice to NCLT, they will be asking the company to hold the meeting of members or creditors. So in that meeting, please note, this is very important. As per section 230, you will be requiring the approval of majority who has voted in favor plus against, representing 2/3 value. Representing 3/4 value. I'm sorry, representing 3/4 value. These two approvals will be required. Majority having 3/4 value will be required. In such case, they can apply to NCLT. Means once they have applied, NCLT will be instructing, directing to conduct a meeting. Once the approval is obtained in the meeting, NCLT will be considering. Okay. So if the compromise arrangement is related to any merger amalgamation, it will be treated under section 232. So under 232, all the steps of section 230 plus additional step, filing with ROC will be there, filing of form CA 15 will be there, such provisions will be added. So 233 is related to fast track merger. If the merger is between holding and wholly owned subsidiaries, small companies, startup private limited companies, small and startup private limited company, that will be going through fast track merger. In fast track merger, it is like this: you will be applying to ROC, official liquidator, they will be giving their opinion. Both the companies, transferor and transferee, will have to conduct the meeting of its members. Approval of members is to be required. 90% members approval. 9/10 value of creditors approval to be obtained. Then transferee company will have to apply to ROC and official liquidator. ROC will be applying to central government. Central government will be forwarding to NCLT. NCLT will be deciding whether it has to go through 232 or 233. Or if the amalgamation merger is between a company which is incorporated in India and notified jurisdiction outside India, that will be cross-border jurisdiction or cross-border merger. So all the provisions of chapter 15 will have to be complied along with the approval of RBI. The payment will be made in cash, depository receipt or both. Then now we'll move to chapter 16 of Companies Act, which specifies prevention of oppression and mismanagement. See, the basic provision, basic thing in this chapter is that the court will not interfere into the internal affairs of the company. Why they are not interfering means, if the court is interfering and the company is passing resolution after that date, the decision of court is immaterial. But in certain cases, the court will be interfering into the internal affairs of the company. Okay, that is known as prevention of oppression and mismanagement. Prevention of oppression mismanagement is one scenario under which the court will be interfering. Okay, so in such case, the application to NCLT shall be made by either by 100 members, 10% of total members. If these two conditions are not satisfied, you have to check one more condition, one or members holding 10% of issued capital, whichever is less. If such application is obtained to NCLT, they will be making, or they will be accepting the case, and they will be passing orders under section 242, and they will be making some provisions under 243 also. Okay. Then we'll move to the SARFAESI Act, which is coming under the banking laws related to banking company. This is a provision to avoid non-performing assets of a banking company. So if a banking company is giving loan to a certain person, a person which is for so many years, maybe 40, 50 years, what they will do is that they will give this loan to another company which is known as Asset Reconstruction Company, ARC. Okay, what ARC will be doing is that they will be taking that debt, financial or receivable, from the bank, and they will be paying to the bank. They'll pay off the entire amount to the bank. Now the transaction, now the dealing is between the borrower and the asset reconstruction company, which is known as asset reconstruction, acquisition of debt or financial asset by asset reconstruction company from the bank. Okay, now what the bank is doing is that the asset reconstruction company will be changing the scenario into an investment opportunity. Like that, asset reconstruction company will be accepting deposits from qualified buyers, which is known as securitization. Okay, so enforcement of security interest is specified in section 13, which means that if an asset, financial asset of a financial institution is becoming non-performing asset, if there is default and it is becoming non-performing asset, overdue for 90 days, 3 months, then they'll make an intimation to the borrower, to secured creditor, to make the payment within 60 days. If it is not paid within 60 days, they can enforce security interest under section 13 subsection 4. ARC are having certain other powers under section 9 of SARFAESI Act. They can change takeover management, sale or lease of business, okay, rescheduling of debt, enforcement of security interest, settlement of dues, takeover possession, then conversion of debt into equity, etc. Such powers are also vested with asset reconstruction company. One thing you have to note with respect to this December examination is that minimum net on fund of asset reconstruction company is now 300 crore. Okay, in material you might be seeing that it is 2 crore. It was 2 crore, but master guidelines of RBI has changed it to 100 crore. Then it was made to 200 crore, and now it is 300 crore. Okay. Now we'll move to Companies Act, Chapter 9 of Companies Act, accounts of companies. You are having 128, Section 128, specifying location, manner, preservation, inspection of books of accounts, where the books of accounts has to be kept, in registered office or any other place in India. If you are keeping it in India, you will have to file with Board of Directors, and you will have to pass board resolution and file the same with ROC. Then manner, you can make it in or preserve it in physical manner or E mode. If you are preserving the same in E mode, you will have to comply the rule 3 of companies accounts rules. Okay, then it has to be certain provisions are mentioned in rule 3 with respect to keeping of books of accounts in E mode. So you will have to comply all such provisions while if you are keeping the books of accounts in E mode. Then preservation for 8 financial years. Inspection can be made by directors. With respect to financial statement under section 129, it should give true and fair view. Schedule 3 accounting standard should be complied. Reopening of books of accounts, section 130. 130 specifies reopening if it is made in fraudulent or fraudulent manner. You will be giving, certain authority will be giving application to NCLT, means it can be given by central government, income tax authority, SEBI, etc. They will be reopening the accounts, and once recasted, it will be final. Then voluntary revision can be made by the company with respect to their financial statement and board's report. If the company is having a belief that their board report 134 or financial statement do not comply with the respective provision, they can make a request to NCLT. They will be approving the same by considering the representation of all other parties, and the board's report or financial statement of preceding 3 financial years can be revised. and revision cannot be made more than once in a financial year. Uh, then with respect to NFRA, you are having section 132. 133 specifies 133 specifies about your accounting standards. So it will be recommended by ICAI, then to NFRA. NFRA will make their own recommendation, will be notified by central government. 134 specified with board's report, signing of board's report, signing of financial statement. Section 135 is with respect to CSR provision. CSR is applicable to any company which satisfies any of the criteria like net worth of 500 crore or above, turnover of 1000 crore or above, net profit of 5 crore or above. Then circulation of financial statement, which is explained in 136. Normally, in listed company, you will have to make it available for inspection for a period of 21 days before AGM. For other companies, you will have to send it to members 21 days before AGM. Then filing of financial statement, which is AOC 4, 137, section 137. Within 30 days of AGM, you will have to file financial statement with ROC. Then internal audit is applicable to listed company, unlisted public company, which satisfies certain criteria like turnover of 200 crore or above, loan borrowing from in excess of 100 crore at any point of time during financial year, 50 crore or above paid up, outstanding deposits of 25 crore or more at any point of time during preceding financial year. With respect to private limited company, turnover of 200 crore or above, outstanding loan or borrowing of in excess of 100 crore at any point of time during preceding financial year, and it can be either CA, CMA or any other professional. Then chapter 10 of Companies Act, chapter 10 is dealing with your audit and auditors. You will have to learn, we are learning about the first auditor and subsequent auditor. Okay, first auditor we have learned with respect to your 139 subsection 7, you have learned about the first auditor, 139 subsection 5, 139 subsection 1 and 139 subsection 6 is respect to, sorry, first auditor you are having 139 subsection 6 and 7, 139 5 and 139 1 is related to your subsequent auditor, and you are having the provisions with respect to the rotation. Rotation is applicable to certain prescribed class of companies like listed company, then unlisted public company having paid up 10 crore or above, private company having paid up 50 crore or above, then any other company having loan from bank PFI of 50 crore or above, rotation is applicable. Rotation means individual one term of consecutive 5 years, after that 5 year cool off. Firm 2 terms of consecutive 5 years, after that 5 years cool off. Then you are having resignation of auditors, removal of auditors under section 140. Then disqualification of auditors 141, different clauses under 114.1 subsection 3 is explaining about the disqualification of auditors. Remuneration of auditors 142, which can be either decided by board of directors or the members. If the auditor is appointed by members, then it will be decided by members. If the auditor is appointed by board, the remuneration will be decided by board, or in the case of CAG auditor, it will be decided by CAG. Okay. Then powers and duties of auditor 143, you are having reporting of fraud also. Less than 1 crore, you will be reporting to board of directors. 1 crore or above, you will be reporting to secretary MCA, which is commonly known as central government. Auditor not to render certain services in 144, accounting, internal audit, etc. Auditor will have to sign audit report 145. Auditor or representative will have to attend AGM. Representative, if he is attending, representative should be CA in practice. Then punishment is specified in 147. The provision with respect to cost audit is specified in 148. Regulated industries, 6 industries are there. Non-regulated, 33 industries are there. Depending upon certain provisions, cost records and cost audit provisions will be applicable. Okay. Now we'll move to chapter 22, which is companies which are incorporated outside India, which is simply known as foreign company. So it is company or body corporate incorporated outside India, having place of business in India, whether by itself or through agents, through physical or e-mode, and conduct any activity in India in any other manner. But it is normally referred as, if any of these conditions are satisfied, the company will be treated as foreign company. So the foreign company will be complying with section 380 to 386, 390 to 393. But if a foreign company, if a company is a foreign company and 50% of the paid up or more of that paid up, 50% or more of paid up is held by Indian citizen, companies incorporated in India or jointly, they will have to comply with these provision and any other provision under Companies Act as if they were a company incorporated outside India. Okay, then now we'll move to the provisions related to cyber laws. Okay, so cyber laws will have sensitive personal data. First part of that provision is related to sensitive personal data. You are having personal data from which identity of a person can be obtained is known as personal data. But sensitive means just like your fingerprints, your biometrics, health records, passwords, etc. That is sensitive personal data. So you are having a rule for protection of sensitive personal data. You will have to make a draft for the same. The approval of a data provider should be obtained, the consent should be obtained, the data should be used only for the legitimate purpose, data should be used for the purpose only for which it was mentioned, etc. Then you are having the provisions with respect to BI and data privacy. BI is a technology driven system in which you are taking data from data warehouse and you are taking so much of data and you are making into meaningful conclusions. Okay, there are so many tools which is related to so many features of BI tools are specified, like your online analytical processing is there, then you are having mobile BI is there, you are having real-time BI is there, locational BI. Certain features are given in your syllabus for with respect to your business intelligence. Then with respect to cyber crime means any criminal activity in which the computer or software is a tool, target or place of criminal activity. It may be either against person like cyber stalking, obscenity. Cyber stalking means physical threat, then obscenity, pornography, etc., defamation, reducing the dignity of a person, hacking, cracking, spoofing, and location, or when you are disguising the identity, spoofing, carding, fraud, threat. Squatting means you are creating an intellectual property website with that of an existing and you are deceiving another person. Vandalism, an external thing is entering into your system and destroying the system. Hacking, virus, trespass. Against government, terrorism, warfare, piracy, unauthorized information, etc. Okay, then you are having the definition of MSME. The chapter related to MSME that has undergone an amendment on 1st of April 2025. So investment in plant and machinery or equipment and annual turnover is the provision for MSME. So for MSME, for micro, it is not more than 2.5 CR and not more than 10 crore in the case of micro, not more than 25 and not more than 100 in the case of small, not more than 125 and not more than 500 in the case of medium. Okay, so this is applicable for December 2025 examination. The amendment was made by the ministry on 1st of April 2025. Okay, in the case of payment to MSME, so payment, if you are dealing with MSME, that will have to be dealt according to the agreed date. You can have an agreed date with the MSME supplier. If they are not having an agreed date, it should be on appointed day. Appointed day means 15 days, within 15 days of provision of goods or service. If you are having an agreed day, that is okay, but agreed date as per agreement should not be beyond 45 days. Okay, that means if you are buying something from MSME and you are giving that, you are telling that I'll give after 60 days, that is not possible. Maximum agreed days can be 45 days. If there is no agreed day, that will be going back to your appointed day, which will be 15 days. If you are making any delayed payment to MSME unit, you will have to pay interest, which will be 3 times the bank rate, and interest will be charged compounded rate, and that will be mentioned in your annual accounts also. So with respect to your insolvency and bankruptcy code, IBC 2016, you can have application can be made either by financial creditor under section 7, operational creditor section 8, section 9, corporate debtor section 10. Okay, so the thing is that you are making application to NCLT. NCLT will be accepting or rejecting the application. Once they are accepting the application, they will be passing 3 orders. They will be issuing a moratorium, they will be making public announcement, they will be appointing interim resolution professional. Okay, then it has to be insolvency resolution process will have to be CARP has to be completed within a period of 180 days. 180 days. Okay, one-time extension of 90 days can be given by NCLT on satisfaction of certain conditions. Then anyhow, this process will have to be completed within a period of 330 days, including the time taken for legal proceedings. Okay, so interim resolution professional, the duty is to constitute committee of creditors within. When the committee is constituted, the committee will be appointing either interim resolution professional or any other professional as insolvency resolution professional. Then what the insolvency resolution professional will do is that he will make an information memorandum. He'll collect the details about the assets and liabilities, and the resolution applicant, one among the financial creditor, will be making the resolution plan. The resolution plan will be approved by the two-third majority of committee of creditors, and it will be given to NCLT after checking by your insolvency resolution professional. If it is okay by NCLT, that is okay. The moratorium is over. If that is rejected, if the resolution plan is rejected by NCLT, what will happen is that it will order the liquidation of company. So section 33 to 53 will be applicable in such case. Now we will have the last part of this discussion, not your syllabus, corporate governance. So corporate governance simply means achieving the object of organization by considering all the stakeholders. Please keep in mind, if you're getting question from corporate governance, don't write external. You can write as many points as you like, but usually I tell this to my students: when you are writing any provision with respect to corporate governance, include the provisions of Companies Act or law, because any provision in Companies Act is relating to corporate governance. You can take any section in Companies Act that is relating to corporate governance, because in one point or through one point or another, it will be protecting or considering the stakeholders. Okay, so any provision, any transaction which is considering the stakeholders may be shareholders, debenture holders, bank, financial institution, creditors, employees, government, public, etc., which is known as corporate governance, or complying the law in true letter and spirit. True letter and spirit in the sense that you are complying the law to satisfy the authorities. True letter and true spirit, you should be having that feeling in your mind. That is the essence of corporate governance. So please, this is my request: if you're writing any provisions, any sections, any questions on the basis of corporate governance, you can write in your own words. You can exceed the limits. I can say that if you want to write so many answers, or if you want to write some external part also, there is no issue, but please make it up to the point. Number two, you have to include the legal provision also. Just quote some section from Companies Act. So Companies Act section will be contributing to your corporate governance. So I have summed up all these provisions within limited time. As in the beginning I was mentioning that since this is a fast track revision, we will be touching the core part only. Okay, so just a revision just before your examination. That was my aim before starting this fast track revision. I think the discussion is clear to everyone. Okay, uh, I might have missed some points since it is a fast moving revision. Some mistakes might be there. Okay, I don't know. Anyhow, all the best for your examination. As I usually say, if you're having any queries, any doubts, you can please contact me. There is no issue. Okay, then all the best for your examination. Do well. Okay, all the best. Thank you.